and IT services and payments coverage at Wedbush Securities. Moshe, good to have you back on the show. Market likes this report. Tell us why.
I would say that numbers were better than expected on perceived lower or actually very conservative expectations. So they beat revenues, they beat earnings, and we've seen actually strong results in terms of cloud or what we call cognitive or digital related revenue growth. That's kind of the probably the biggest driver for the rally in the stocks, and there are probably other factors as well, such as short covering.
Is that cloud cognitive segment part of the Red Hat business, or can we take these separately and figure out what exactly is coming from the acquisition and what's not?
Yeah, that's actually a really good question. And our biggest issue with IBM, and obviously, we've been covering it for a while, and the story is kind of a black box to us sometimes, and I'll tell you why. So Red Hat showed decelerating revenue growth during the quarter, especially comparing it to the last quarter. On the other hand, you've seen results in what the company calls cognitive or digital actually were pretty strong. So now there are a couple of different things going on here. You have a legacy business that IBM has, both in software and services, where you're seeing a lot of the delivery shifting to a different delivery model, which is categorized under digital. So remember, the old services model was capital intensive and people intensive. The new model, where the company's using software as a service, cloud, and automation, is actually people and capital light. So the real question here is, what's really driving this growth in digital? Is it really incremental new business? And you can make that argument. Or it's actually the legacy business that's shifting to a digital model. And that's why the numbers look pretty strong. And that's why it's a bit confusing, and I don't really have a good answer on that. Now, we were looking for certain signals that things are stabilizing at IBM. So we're looking for better bookings. The bookings are actually down 20%. We're looking for better visibility. But management decided not to provide guidance for the second half. So I don't know if we're in that inflection point where we can come out and say that things are okay. Maybe we're getting there, but it doesn't seem that we're there at this point post this earnings release, despite the fact the stock is up 5% on pretty low expectations.
It's pretty interesting, and it's kind of bizarre in a certain way, because the reason I asked the question is I imagine, and it seems like you agree, that trying to figure out where the growth is coming from exactly, or where the most potential for growth is coming from, is really important, as well as trying to figure out whether or not the price paid for Red Hat is going to be a good investment over time. I mean, they paid a pretty big price for this company. How come there's so much sort of opacity in the way they're delivering the numbers and in the way they describe the company to analysts and to the public?
It's all about disclosure, and it's all about transparency. And if you keep on changing the way you report numbers and you report the metrics, you will create that confusion that you're talking about. And that's really been challenging, trying to assess the progress that IBM has. We can, we can estimate that roughly 30% of the revenue base is generated from what we call digital or cognitive. So that part of the business hypothetically should be growing north of 20% a year. But then a large chunk of the business is still generated from those legacy-based revenues that are still getting cannibalized on an annual basis.
Right.
And ultimately, you will get that inflection point once a larger portion of revenues will get generated from digital. Now, COVID is kind of interesting because it is accelerating the adoption of cloud. So that number, I mean, we kind of expected Red Hat's numbers to look even stronger because of that, and they were not. But on the other hand, what COVID is also doing is accelerating the shift away from the legacy model and potentially accelerating the cannibalization phase that we're going through. So these are the two factors that are going through the model right now. and may actually continue to show, to translate into continued instability on the revenue, or at least on the organic revenue line for IBM.
We've got some numbers up on the screen to put this in perspective. That is Bloomberg data, the way they classify the different branches within the revenue stream. Cloud up 30%, but the point that you're saying about the area of cannibalization that's still happening in the legacy businesses, global business services, tech services, which Bloomberg pens at about 56% of IBM's total revenue, that was down 5.5%. So there's clearly this bifurcation that you're describing, Moshe, that shows up. So I wonder if it's possible to step back and you just look at this company on a relative basis, say next to other companies in tech of their size or in their ambition for cloud, and say, here's what's coming out on the top line, here's what's going on the bottom, here's what's making it to the bottom line, and here's what's in between. What do they need to do? Do they need to cut? Do they need to accelerate the top line? Where does the incremental next step come from?
Stability in revenues. You have to show multiple consecutive quarters with some sort of an organic revenue growth number. It could be 1%, it could be 2%, but it just feels that this quarter, excluding Red Hat, organic revenue growth would have been minus 7%. So we need to see some sort of positive organic revenue growth to come out and suggest that this turnaround is actually taking place successfully. It just doesn't feel that we're there yet. Now, if you would have told me that Red Hat went from 20% growth last quarter to 23% growth this quarter, it actually went to 18, I would have probably told you that this transformation is actually headed in the right direction. But we haven't seen it. And I'm not sure exactly what's driving that performance this quarter. Could it be COVID? Maybe. If we see an acceleration next quarter, maybe we'll change our mind. But I think we need to see some of these metrics to get more comfortable with the outlook for this company.
I see. And right now, where does that lead you? Is this a company that is reasonably priced by the market, getting some of the NASDAQ froth now in the bounce this morning? Are you looking at changing any of the price targets? From what I see, yours is still below where we're at right now.
Our price target is 140.
140, okay.
The stock has been reasonably priced for I would say for 4 or 5 years. So it's been a value tech name for a long time. And I don't know if that changes anytime soon, given the fact that we're not there in terms of fundamentals and that stability that we're talking about.